We'll continue our discussion on value creation. So before I begin our conversation on value creation, let me discuss what we have done so far. So what we have done so far is I've introduced you the fundamentals of value creation. That is, return, cost, and growth. And we saw this through various examples, be 2001 IT bubble or 2008 or, financial crisis, Lehman Brothers. Then any financial crisis, even if you go in the past, is primarily that, the fundamentals were not followed or they were not given attention, and that is why we saw that, the value creation happened or the value destruction happened at that point in time. Few investors, just because the companies did not follow the concept of return, cost, and growth, and these were not given proper attention. So let's deep dive further into these topics and understand what are the real pillars of value creation. So these are the 4 pillars of value creation, that is, profitability and growth. Rearranging investors' claim doesn't matter. Third is market expectation, and fourth is best ownership. So let's talk a little on profitability and growth first. But for any company, let's say these are expectations. And let's say this is year, and we are talking about company A, they have their revenue. And less the cost part. What we'll get is a bit data. Then you deduct depreciation and amortization. You will get EBIT. You deduct taxes and interest, you get net profit. So what we're trying to say here is growth will represent this year-on-year growth. This is 110, this is 120, and so on south. There is growth happening from one year to the other, from second year to the third, and so on. What we're trying to say here is in case this growth is low or it reduces or becomes negative, that will not create value. So growth has to be positive. That is one principle we have to follow. And the second principle is our profitability. We'll get into more detail in our return on invested capital, but for now, let's say our EBIT as our profitability, although this will also represent margin, but this will consider depreciation and amortization. So we take into account EBIT and why we have not considered, let's say, interest before taxes, because what we see here is investment is made in the form of debt or equity. So that is why we have to consider the interest portion as well. We are valuing a company not only from equity holders' point of view, but it's for the entire capital in the company in the form of equity or in the form of debt. So we are saying there has to be good profitability. We'll look into in terms of the ROIC. We need to make sure that we have positive ROIC as well. Let's see here. This covers our first pillar, which we discussed here, that is profitability and growth. We are saying there has to be a combination of growth and return, which will result into positive cash flows, which is your basic value creation driver. And what really this growth and return does is it indicates what will be the cash flow of a company. We move on to the next pillar, that is rearranging investors' claim doesn't matter. We introduced you in the form of, our example of financial crisis 2008, that there was a floor assumption that if you use a lot of leverage, then you'll create a lot of value. This was proven wrong in our 2008 financial crisis. When you're making investment or a company generates a return, whether it's generating return through shareholders, which are in the form of equity holders, or through debt holders, it doesn't really matter. What really matters is if a company is given $100 million, will they be able to generate, let's say $200 million in 1 year or not? If they can, they have created value, value of 100 million. If they cannot, they have destroyed value. So as simple as that, it doesn't really matter whether it comes from equity or it comes from debt. Sure, when you're looking into different claims of valuing, what is the return of equity holders or debt holders? Sure, for them it will be considered. What is the return they have generated from a company's point of view? What is the company's value creation which they have done or they have a potential of creating? Does not matter whether it comes from equity or it comes from debt. That you have to consider in a way, total capital. Total capital, be it equity or debt. It doesn't matter even if you try to, switch, there are a lot of bonds which can be switched into equity after some time. That doesn't mean that, company will start creating more value just because bonds have been converted. Well, they have to look into it how they will rearrange the claims, but that doesn't create any value. So this does not matter. This is a big no. So I'll just mark it in a different color. This doesn't really matter. What really matters is total capital. And that's about it. So whenever you look at companies, which are trying to rearrange their claims, moving bondholders to equity or equity holders into bonds. That doesn't really matter from a value creation perspective. So you don't have to pay a lot of attention to that. Focus on the fundamentals, which are profitability, growth, and cost. We move on to the next, that is market expectation. Let me use this example here of Apple. Well, there is a market expectation from Apple. And what Apple does is it invests a lot in R&D. It does a lot of research, and it comes up with innovative products. First, it came up with, iPods. Then they came up with iPhones. Then they came up with iPads. And now they're actually working on some other innovative stuff, and this will continue. And within this, also they continue to improve the performance, and they were newer versions addressing newer versions, addressing various other needs of the clients. They were able to create immense value through all this innovation. So what market does is, if market is saying, if analysts are projecting, let's say the revenue will grow by 30%, which may be a very high number for Apple. But if Apple doesn't meet this 30% growth number, then market will not value this company. The performance of the company from a capital market perspective will go down. But let's say there is some other company in similar space, and analysts have forecasted that that company will generate 15%. And in a way, let's say Apple creates 25% growth. The market will value it less. So in a way, it will go down. The share price will go down, and there is another analyst 2, who does similar, analysis for some small-time company, let's say, and they forecast 20% revenue growth, and that company delivers, let's say call IT company X delivers 25%, which might be same as Apple, but in this case, the market will give it as a positive sign, and the value of this company will increase. The capital performance of this company will improve. The share price of company X will increase in similar scenario when we have similar growth. But just because analyst or the market expectation is more from Apple and less from this company, the market performance will adjust accordingly, which will discount. The performance of 25% in revenue growth and share price of Apple will go down with the Ys. For company X, the share price will go up. Our last pillar is best ownership. Well, not many people would, they don't relate to this concept of best ownership. But the point is, most of the mergers and acquisition deals which are taking place anywhere, any part of the world, is primarily driven with the fact that who will be the best owner of a company. Just to give you an example. 1. And during this journey of a company, what really happens is the ownership at times also changes. One of the finest example on the ownership point is even when a private equity firm is investing into a company, they would have one person sitting in the board or one person actually leading. As you know, they'll appoint a CEO of that company, just because that one person can create more value than the current management team. So what we have done so far is we have started all these pillars. Major drivers, one is the profitability, the other is cost. The third is growth, and we looked into these 4 pillars, that is profitability and growth. This really matters because eventually that will generate cash flows. The second is rearranging investors' claim should not be considered. You should just be aware of what is the total capital of a company. The third is the market expectation. If market expects you to perform better, and even when you beat that expectation, then only your value will be created. The fourth concept, which I told you, is on the best ownership. Different owners of the business will bring in different skill set and strategies, and that will impact cash flows differently. So we need to pay particular attention if there is any change in the management. That can impact the value creation part as well. This covers our value creation of a company, why we are valuing a company, and what are the pillars of value creation. Now we get into detailed topics in terms of how do we actually value a company.